afternoon and welcome to the special year-end edition of Asian Midday Market Watch. I'm Brian Fernandez and with me is my co-host Jeffrey Halley. And our guest today is Kelvin Wong, Senior Market Analyst at Oanda. Kelvin, welcome to the show. And first of all, thank you very much for being our regular guest on the show this year. We certainly appreciate your insights. Now, today we get your insights and to look back at 2023 and also to look ahead to 2024.
Yes.
Yeah, so go ahead. Sorry, Kelvin.
No worries. So basically, let me look from a Singaporean stock market perspective. So the Singapore stock market has been pretty if you look at the STI, it's rather flat, or in fact, it's been flat for the last 3 to 4 years, underperforming the most of the major benchmark indices. So one of the reasons over here is that we start to see this persistent Singapore underperformance in the last 1 to 3 years. Yep, I mean, we know that some sectors actually outperform because of number one, we started at the start of the year with the risk of stagflationary risk. Why stagflation? Because we start to see growth in certain of our key trading partners, especially from China, starts to temper off after that initial spurt up in their reopening narrative that actually start to dissipate throughout after Q1 this year. Then thereafter, we also have the fear of inflation getting out of control globally, but that seems to be off the table right now after we start to see 3 to 4 months of kind of a growth, inflation growth deceleration worldwide.
So maybe we could zoom out a little bit, Kelvin, and perhaps look at the global economy. You could perhaps give our viewers an insight into what you believe were the key events playing out in markets in the first half of 2023.
Yes, so for the first half of 2023 this year, I mean, a bit of recap over here is number one, a lot of, we call it, put away that global strategies or analysts or even economists, they actually pencil in a potential US recession. So we know that US is one of the key major economy. Whatever US sneezes, the rest of the world sneezes. So i.e. we are potentially behaving to a world recession in 2023. But fortunately, that doesn't happen. And that goes against market expectation, where we start to see a very strong rally in the US stock benchmark indices. So if you look at the Nasdaq 100, the one that is leading the fort, especially driven by the mega cap 7 stocks, which is up with a whopping about 80%, depending on which component you look at. So all these are, we call it a kind of a surprise, almost all the, we call it the strategies sphere of thinking, that's saying that, hey, in fact, what we could see over here is that despite the fact that, yes, we enter into the world of a state of stagflation risk, and also with US central banks and the rest of the world having this higher for longer interest rate mantra, that actually didn't derail off the animal spirits in certain pockets of the world. But however, if you look at the current disappointing right now, or the underperformer will be China and its proxy, which is the Hang Seng Index, and unfortunately Singapore as well. Why? Because Singapore, we do have a close trade relation with China. So China, in fact, right now, if you look at the CSI 300, is on the mark of a third consecutive year of losses, 3 consecutive year losses, with the one that is much faring worse will be its proxy, the Hang Seng Index, which is now ongoing for a 4th yearly of annual losses. So that is actually the worst consecutive yearly losing streak on the Hang Seng Index so far historically. So all in all, right, what we could see over here, the crux of the problem over here is number one, we start to see a structural problem arising up from China due to its this property developing market that has a high significance of wealth concentration in China itself, which is a kind of a society problem. That means we start to see unfinished homes in China. Then we have wealth related products that are being tied to property developers stock price or property developer bonds that took a hitting this year. So it kind of sound the alarm bell that China may start to see a big potential. We call it a draw off or a property bubble burst than what Japan faced in the early 1990s. So there's a lot of similarity going on this juncture that drive this what I call very weak structure. We call it sentiment in the Chinese stock market, which actually has a negative feedback loop into the local Singapore market as well.
Now, I want to ask and have an open question to both of you. Thematically, Kelvin pointed out to something which is a very clear theme through the year. Is essentially, yes, we have record highs in the US markets, but essentially on Nasdaq, it's just the 7 key stocks that basically have contributed to this rally. Now, my question then is, because of that concentration risk, are we not seeing deeper issues within the US stock market as well? And is that going to carry through to 2024?
Well, maybe perhaps I could start first over here is that if you look at this current round of a medium-term uptrend leg that's kickstarted in October this year, this last push, this recent we call it a rally, is most driven by, yes, we know that the Nasdaq is at an all-time high, but in fact, it starts to spread on to the rest of other, we call it cyclical sectors. So in fact, this time around, the Dow Jones Industrial Average actually made a first all-time high first, followed by the Nasdaq 100, which was made yesterday in terms of reaching above their previous high. So what we could see is that right now, we start to see a bit of spreading out of the concentration to the rest of other cyclical sectors in US, which is a positive thing. But on one hand over here is actually pretty much driven by the fact that we now have started to see a much more clarity in the Fed guidance towards their interest rate trajectory next year. So that actually helping this spreading out of this concentration risk that is in the start of early this year is being heavily weighted to the Magnificent Seven. So if we look at one big caveat over here is that the US cannot slip into a recession, because if you look at the past historical Fed pivot, that means Fed dovish pivot, that means from a hiking cycle straight to a cutting cycle. If that actually takes shape during a recession period, the performance of the US market in general, if you look at the last 7 or 8 this Fed dovish pivot historically, it doesn't bow well to the US stock market.
Okay, that's
so
interesting.
So what you're saying is basically, if the US economy does slow down and the Fed starts cutting rates faster and sooner than the markets or the Fed are saying, that won't necessarily translate to equity market strength. And in fact, it could be the opposite.
Yes, precisely. Because if you look at the current situation right now, based on FactSet data, is that I think next year they're penciling double-digit earnings growth perspective in the S&P 500. So that's a very rosy scenario, indicating to us that the US economy is more of a Goldilocks scenario rather than a recessionary-like scenario. So if that recession really hits down the wire, which once it hits, I mean, it's the official number, it will be pretty much lagging. So we will start to see a much more, we call it a sudden swift downgrading of earnings growth potential. So that could actually trigger that sentiment negative feedback loop pretty much erupted the year.
Yeah, there's a lot of good news built into US stock prices and other markets around the world as far as forward earnings growth goes, isn't there?
Yes, precisely.
Now, and how about 2024? I mean, what's your view on the markets in the first quarter of the year?
Yeah, sure. So maybe I'll touch on the Singapore stock market perspective. So we know that the Singapore stock market, there's a little, it's a bit weird for Singapore stock market because we are not really a growth oriented, we call it a proxy as per se, because majority of the Singapore investors has a high love for REITs, Singapore REITs. So view these Singapore REITs as fixed income kind of quasi fixed income securities, where Singapore itself, we know that we have a lot of property in a way, and this property is being synchronization out for investors to have a stake in this property, be it office house, be it industrial estate, be it offices, be it we call it a healthcare facility. So this we call it REITs, S-REITs index has been underperforming since start of this year. So this primarily the fact that because it's a fixed income like instrument, it actually works like a bond. Okay, so it actually moved in line with that bloodbath in the global bond prices that was seen from 2023 as well. So what's interesting over here is that the recent rally in this S-rate has been more in line related to that, number one, an ease off in global inflation pressure. The US 10-year Treasury ticked down lower. Then after that, further weakness on the US 10-year Treasury driven by that Fed dovish pivot that was seen last week ago. So what we could see over here is that it seems to me that over here is that potentially if the Fed were to maintain this rhetoric of a more going away with their having interest rates staying at a higher level for a longer period, it could benefit this S-rate at this point in time, at least in the first half of 2024, given the fact that it has fallen off pretty much significantly in the last 2 years. Okay, after hitting close to a 52-week low in the previous month of October. Yeah, in the previous month of October. So very interestingly, if one could actually overlay the chart of the S-rate, it actually moves pretty much in line with the long-term US Treasury bond price, which is the TLT in the exchange, the popular longer-term US Treasury bond that is listed in the New York Stock Exchange. So notwithstanding the fact over here is that also given the fact that we know that there could still be a potential recession scenario coming into the picture in globally. Why? Because do not forget, next year will be the US election. And if you look at very interestingly on the polls right now, the controversial Mr. Donald Trump actually leading the Republican camp. So despite all the negativities that he created in the previous presidential we call it days in the US. So in fact, I think he's leading in about 51% in terms of polls. So it's way above the margin of the other four candidates. Yeah. So let's say if you have a hypothetical scenario that if you manage to beat all odds despite the ongoing legal allegation that's been imposed on Trump, and if he starts to be the next president again, I feel personally there could be much more volatility going forward in the global markets. Why? Because it could be another Trump, number one, putting away that of him using social media as a tool to blast out his opinion. So that could actually what happened, that on-off trade war, US trade war optimism, US trade war pessimism, that kind of scenario could play out again, using his we call it him as a president to do such we call it social media opinion. So that could create a bit of high volatility to the market. And do not forget over here is that in fact, if Trump doesn't comes into the picture as being the official president next year, but ahead into the US president election, I believe that the US-China scenario relation, this is a thorny issue, will likely be brought up again as put away in a very negative way as a punching bag. Because if we look at the current, a month ago, where the China top leadership just concluded their economic workshop in a way, it kind of lay down the groundwork for next year, a big economic plan for China. So what they did over here as number one policy this time around for 2024 is modernized industrialization. That means, i.e., we are talking about China wanting to actually build a high-tech semiconductor industry in terms of getting knowledge, the best know-how, and the best materials to build that cutting-edge chip, to build a very sophisticated Internet of Things, we call it industry. So don't forget, that could be used as the president candidate as a chip to actually accuse China again of national security threat that being imposed to US. So as we head into the second part of this year, I believe that, in my opinion, there could be this battle between because a talk or a accusation saying that China still remains a national security threat to US, and some of the president candidate may come up with different kind of ideas on how to neutralize this threat, given China's ambition of this modernizing their industrial policy, making it their top economic, we call it, goal next year. So something to watch out for as we head into the later part of the year, where if this scenario start to rear its head again, potentially it could delve out that ongoing, we call it, for easing, liquidity easing measure or liquidity easing condition that we are seeing right now.
Kelvin, thank you very much for your insights. Jeff, would you like to add anything else before we end the show?
I think people aren't really looking at the US election next year. So I'm completely aligned with Kelvin. I think it will be the major event for 2024. It's just that we're going to have to wait for most of 2024 to occur before we get to that point. We have a lot of geopolitical risk going on in the world, as we know. I think what will really drive markets, though, is what Kelvin touched on before, is the trajectory of the Federal Reserve's easing path, because markets at the moment have built in a lot of rate cuts even from the first half of the year, and the Fed's really quite hard right now to push back against that scenario. But we'll have to wait and see. I mean, the Fed was one of the greatest proponents of transitory inflation, and we know how that story ended. And the question is, are we going to see another replay of that, but the opposite way around? I just wanted to touch on one quick thing with you, Kelvin, and that's your near neighbour, Malaysia, and looking at the Malaysian ringgit, which is very weak against the Singapore dollar, persistently weak against the Singapore dollar, but has also been persistently weak against the US dollar this year, even as the US dollar has actually weakened against most major currencies over the last few months. And I'm wondering if I could get a few quick thoughts on that and how you see the ringgit playing out into 2024.
Yeah, sure. So if you look at the situation right now of this persistent ringgit weakness against Sing dollar, is number one is due to internal political risk in the Malaysia politician camp itself that is driving this ringgit weakness, and also we do have the ringgit has a kind of a very weak structural foreign debt, we call it position against GDP. So if you look at the foreign debt as GDP is one of the highest in Southeast Asia, so potentially that could actually kind of put a damper on the ringgit rate against Sing dollar. So that should explain why the Sing ringgit rate is a 52-week high right now. So going forward, right, what we could see is that if we will start to see the US dollar starts to persistently weaken into 2024, that could actually elevate a bit of what I call ringgit weakness against the dollar heading into next year, and as well that hopefully we do not see a kind of a major internal political flare-up again in the Malaysian politics. That could also be at least beneficial from the ringgit perspective. Yeah.
Now, Kelvin, thank you very much for your insights, and thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, on this, a special year-end edition of BizTech's Asian Midday Market Watch. I'm Brian Fernandez.
And I'm Jeffery Halley.
And catch the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.